Welcome back. We are speaking with Stephen Bleiberg and David Siino, both portfolio managers at TD Epoch. Gentlemen, we talked a bit about earlier on just the big picture, the way that you evaluate companies in terms of quality and cash flow and what metrics make sense and what don't. I wouldn't mind just maybe if we could get into a little more detail about what you are looking at specifically when you're looking at what companies that you want to put into the portfolio. So, Steve, I'll start with you again. What is the process or metrics you use when you are generating ideas?
Sure. So, we do think of ourselves as, fundamental managers. But even no matter how fundamental you say you are, you have to have some way to narrow the universe down. There's thousands and thousands of stocks out there. You want to make sure that, you're exercising your judgment most effectively, narrow the universe down to some set of companies that you can do a deep dive on and be most effective in finding good performers. So we have a couple of tools that we use to get the process started. Basically, one is a screen where you pass or you fail, and the other one is a sort of a ranking model. So there's a number of criteria we screen stocks for. Given what I was saying a moment ago, not surprising that number one is return on invested capital. We're looking for a premium over their cost of capital of at least 5%. We have a couple of growth metrics which are not particularly heroic. Basically, what they boil down to is we're looking for companies that can grow at least as fast as the economy or better. We're not demanding 10, 15, 20% growth. Just as long as you can keep up with the economy or do better, that's fine. And then we look for very high profit margins as well, because that's sort of a good way to screen out companies that are growing, but just sort of for growth's sake, and they're hurting their margins in the process of doing so. So that gets the universe down that screens out about 90% of the names in the universe. Then we apply a proprietary ranking system we came up with, looks at a whole bunch, almost 24 different variables, most of them based on free cash flow metrics, basically looking for companies that are, as we've said, generating free cash flow, allocating it sensibly, ranks the stocks relative to their global industry peers. And that helps us narrow the universe down even further, so that starting from a U.S. universe of 3,000 or 4,000 or 5,000 names, that gets us down to maybe 100 to 150 names, of which obviously we already own some of them, but it gives us a smaller pool to work with to start doing a deep fundamental dive on those that David can tell you more about.
All right, well, let's get to David then. So, David, you've gotten the universe narrowed from, again, thousands to hundreds. And then it's your choice to think about, how do you go from being interested to actually adding it to the portfolio? What do you look at?
Sure. Good evening, Kim, and thanks again for having us on the program. So at a very high level, we ask ourselves two questions when we are considering a name. Those are, how did we get here and where are we going? How did we get here being, why does a company earn high returns on capital today? What are the advantages that it enjoys? Does it have a high margin business, as most of our businesses do, or is it a business that is a very efficient user of capital, or ideally both? So in the how did we get here category, if it is a high margin business, we ask ourselves, well, does this company enjoy a price advantage relative to its peers, and why? And does it enjoy a cost advantage relative to its peers, and why? That's the first part. That's fairly fundamental finance 101, if you will. The harder question to answer is, where are we going? That is, how sustainable is the current level of profitability as measured by returns on capital? How sustainable is that into the future, and for how long? That is also a two-part question. The first thing we ask ourselves is, what is truly unique about this business? Does it have a technological advantage? Does it have, by definition, difficult to replicate physical assets? Does it have a very skilled management team? Does it have brand equity? Those are some of the things that make a business unique. That's good to be unique. Lots of businesses are unique. You may be able to see over my shoulder here the Empire State Building out of one of these windows. That is a unique property, but it is a fixed structure. It is not a growth property. A company cannot, the owners of that business cannot reinvest and make that building any taller. And this is the capital reinvestment strategy. So we need to identify opportunities that a business has, either organically or inorganically, to reinvest in their business and compound the terminal value of that business over time. We are mindful of risks, be they technological obsolescence, regulatory risk of consumer tastes changing, risk of new entrants entering the company's line of business. All of those things we need to be mindful of. Bad behavior by management is a big risk as measured by how they allocate capital. And to that end, we pay very close attention to how management team is compensated. What are the KPIs that reward them? Are they growth related, which are good, but is that growth that creates value? Is management incentivized to not just grow, but grow in a way that they earn a return on their capital greater than their cost of capital?
Go ahead.
Sorry, go ahead, Kim.
No, you go.
Okay. So the last piece of the puzzle is we will not buy such a business at any price. We do take into consideration the percentage of a company's cash flow that it is reinvesting, and at what rate of return we can expect to earn on that reinvestment. We're willing to pay fair value for a great business as opposed to paying a great price for a fair business, the old Charlie Munger axiom. So this is not a quality at any price strategy by any means, but we are willing to pay a fair value with the belief that businesses that do earn a premium to their cost of capital will compound shareholder wealth over time.
You know, it's when you say it like that, it sounds, I won't say simple, it sounds clear. And I'm sure it's so hard to do when you're actually trying to get out there and see all these things. I should let people know who are watching, we're going to give some examples of what that looks like in terms of some portfolio stocks that you own and maybe some of the ideas as to why. Before I do get to that, though, and you mentioned a couple of these, I thought was just as interesting as, you know, why that you're attracted to certain companies and bring them in, but probably the same conversation why they stay in. We have a chart here that you know, and you mentioned something about management bad behavior. I'm sure that's something that is keen on your radar to understand, you know, do they want to stay there? But again, we're just looking at some of the reasons we have for selling a stock. So just even though it's gotten there, you're not, you're clear as to what it takes to remain there.
Yeah, so we do sell stocks. We've spoken a lot about why we buy stocks, why we might sell them. You just mentioned one of them. I'd say one of the most frequent reasons we sell is because management misuses shareholders' money, misallocates capital, as most evident in M&A, which not all M&A is bad. Most of it is. And if we hear a management team say, well, this deal is going to be accretive to earnings in year 2, well, that's great. Well, but are you earning your cost of capital in year 2 or year 3? It's not so much a concern of ours if an acquisition is accretive to the bottom line. That's almost meaningless to us. We want to hear that management is at least thinking of its cost of capital when it is making acquisitions. And if sometimes they make fairly large acquisitions that, in our view, we don't understand either the financial or the industrial logic of the transaction. Yeah. So that is cause for us to sell. So another reason is simply that the world changes. Owning a business in 2017 that has a visible patent cliff in 2023, well, we say, well, we have 6 years in front of us that are fairly visible. As you get closer to 2023, you're asking ourselves, is this still sustainable within our investment time horizon? And if, say, a pharmaceutical company cannot fill that patent hole that is coming and is very visible in an economic way, that is another reason for us to sell.
David, I apologize.
Yeah.
I'm going to jump in just because I do need to hit a commercial. But when we come back, we're going to continue the conversation and get some real world examples of which of these stocks fit the criteria that Steve and David were talking about. You're watching Money Talk. We'll be right back.